Imagine owning a small piece of Apple, Tesla, or Amazon, and watching your money grow as these companies succeed. That's the power of the stock market. But for most beginners, it feels confusing, intimidating, and even risky. The truth is, once you understand the basics, the stock market becomes one of the greatest tools for building wealth. So, we're going to break it down step by step. But first, a quick disclaimer. This is not financial or investment advice. Before we dive into the stock market itself, let's first understand what a stock really is. What is a stock? When a company is created, it needs money, called capital, to operate and grow. This capital is divided into equal units. Each unit might be worth $10, $100, or another fixed value. These units are called shares or stocks. When you buy a stock, you're not just buying a piece of paper, you're literally buying ownership in that company. If you own even one share of Apple, you own a fraction of Apple itself. Now that you have learned what a stock actually is, the question is, where do all these stocks get bought and sold? That place is called the stock market. What is the stock market? Think of it like a giant supermarket, but instead of food items, it sells ownership in companies. In the United States, the two biggest marketplaces are the New York Stock Exchange, or NYSE, and the NASDAQ. Every day, millions of investors trade billions of dollars worth of shares in these markets. How prices move. All right, so why do stock prices keep jumping up and down every single day? It all comes down to one simple thing: supply and demand. If more people want to buy a stock than sell it, the price goes up. But if more people are selling than buying, the price goes down. Now you might ask, what makes people suddenly want to buy or sell? Well, a lot of things. How well a company is doing, its earnings reports, breaking news, changes in interest rates, or even big global events. In the short term, prices can look totally random, like they're bouncing around for no reason. But in the long run, the market usually reflects the real growth and value of businesses. So when you see those price charts moving up and down, remember, behind every tick is just millions of people making decisions, buying, selling, and reacting to the world. Why companies issue stocks? So, why do companies even bother selling shares? The answer is simple: growth. Imagine Tesla wanting to build a new factory. Instead of borrowing billions from a bank, it can sell shares to the public. In return, Tesla raises money, and investors become part owners of the company. Why people invest? Now let's flip the question. Why would you, as an investor, buy a stock? There are two big reasons. 1. Capital gains. This happens when the stock price goes up. If you buy at $100 and later sell at $150, you've made a profit of $50. 2. Dividends. Some companies share part of their profits with shareholders. If you own their stock, you get a small payout, usually every quarter. Risk, diversification, and time. Now let's talk about risk. Stocks go up and down in the short term, sometimes dramatically. That's completely normal. But here's the key. You don't have to put all your money in one stock. That's where diversification comes in. Spreading your money across many companies, so one failure doesn't sink your entire portfolio. History shows that even with crashes and recessions, the U.S. stock market has grown significantly over the decades. Time is your friend. The longer you stay invested, the less those short-term bumps matter. Compounding in action. This brings us to one of the most powerful forces in investing: compounding. Compounding means your money makes money, and then that money makes more money. It's like a snowball rolling downhill, getting bigger and bigger over time. Here's an example. If you invested just $100 every month into a simple index fund and earned the historical average stock market return of around 10% a year, after 30 years, you'd have over $200,000. That's the power of letting your money grow and compound. Costs and fees. Here's something that quietly eats into your profits: fees. Every dollar you pay in fees is a dollar that's no longer growing and compounding for your future. The good news? Most brokerages today let you trade with zero commissions, which means you keep more of what you earn. But here's the catch. Some investments, like mutual funds, still come with high management fees. Those costs can add up over time. That's why many smart investors prefer low-cost index funds or ETFs. They usually charge just a tiny fraction of a percent each year, leaving more of your money where it belongs, working for you. How beginners can start. Now you might be wondering, how do you get started? The good news, it's easier than ever. Apps like Robinhood, Fidelity, or Vanguard let you open an account and start investing with as little as a few dollars. The key for beginners is simple. Start small. Don't put all your money in at once. Diversify. Spread your money across different stocks or ETFs instead of betting on just one. Think long-term. Wealth grows over years, not overnight. Emotions and psychology. The biggest challenge in investing isn't knowledge. It's emotion. When markets go down, fear takes over. When markets go up, greed takes over. Both can push you to make bad decisions. The solution? Stick to a plan. Automate your contributions. And don't obsessively check your portfolio every day. Successful investors stay calm and focus on the long term. The stock market isn't just for the rich. It's for anyone who wants to build a better financial future. The sooner you start, the more powerful compounding becomes. So, if you're serious about growing your wealth and learning how to make money work for you, hit that subscribe button right now, because your journey to financial freedom starts today.